This is the final video of my Technical Analysis Basics series, and what we're doing today is something I hope you find pretty exciting. We're going to take all the concepts that you've learned in the previous 5 videos and put them into one concise strategy. I'll walk you right through that strategy, and in fact, we're using data and charts as of the very beginning of 2025. You're taking a look at the things I've taught you in real time as I'm looking at them January 28th of 2025. So I hope you like it. So we'll start off, as we covered in our very first video of this series, with macro market analysis, which includes the phase and the trend of the market. And after each one of these segments, I'm going to do a quick series of observations so you can see how my mind works when I'm covering these tools. Now, keep in mind that I've got to keep this video fairly concise, so I'm not going to cover every single tool I will use. I'm giving you the very most important ones, but honestly, if you just follow the tools I'm covering about today, you'll be leaps and bounds ahead of 99% of the investment population. Trust me on that. So we're going to use the S&P 500, and I'm looking at this chart near the end of January 2025. So what we've got here is a weekly chart of the S&P 500 with a 40-week, which is considered similar to the 200-day simple moving average. And remember our rule: when a market is making higher highs and higher lows, we are in an uptrend. It is supported by the 200-day or 40-week moving average. The trend only changes when we see a lower high and a lower low and a break of the 200-day. So if we take a look at what's happened, this is going right back to 2020. You can see back in 22, we had those rules act where we had a lower high and a lower low and a break of the 200-day. So that was a bear market, and literally value trend did get out that spring. Actually, April 1st, I believe, we pulled out about 30% of our equity platform to holding cash and rebought right around here. Well, right now, you can see that we are making higher highs and higher lows. And you might recall, I noted on that first video that just because the market breaks the 200-day, it does not mean you sell. It's an indication there may be trouble, but until it actually makes a lower high and a lower low, you're still in the market. In this case, it made a high, a low, and then after breaking momentarily through the moving average, it moved much higher to a new high and a new higher low, on and on. As of January 2025, we are still making higher highs and higher lows. Well, right now, in fact, as I look at the market, in fact, I'll back this up a little bit so you can see a little bit better, is the market is just barely taking out its last high, but it's on the verge of doing so. Now, it may decide to go flat. We don't know, but at this point, I cannot say that we're anywhere near a downtrend. We're either about to make a new high or we're going to consolidate. That is all we can say. Remember, in my first video, I said, we don't know what it's going to do. We only know what it's doing. At this point, the market has the makings of an uptrend or possibly consolidation, but you stay in at this point. So, observations from that chart. We're making higher highs, higher lows on the weekly chart. It's above its 200-day. The indications are bullish. Step 2, macro market breadth. In the 5th video, I talked about breadth and cycles. Well, we want to look at how, in this case, market participation is versus the more concentrated S&P 500. And what we're looking at here is the Dow Jones Industrial average versus the Dow Jones Transportation average. The industrials are in red and the transportations are in black. And what we can see here is that we have negative divergence on the transportations. Well, the industrials continue to make new highs. The transportations are falling out of bed. That is a warning sign. Conclusions on that chart is the Dow Jones Industrial Transportations are showing bearish divergence. So we're noticing that the internal market health is bearish. The market does not have wide participation. Does that mean we sell? No, because remember, rule number 1 is, what's the trend? The trend is up, but we are seeing signs right now, as of late January 2025, that internal breadth based on the industrials versus transports is not looking healthy. We need to keep that in mind. The next thing we're going to look at is market seasonality, also covered in video number 5, where I talked about market seasonal cycles. There's the best 6 months and the worst 6 months, as you guys might remember. Markets tend to do very well between the end of October and May, June. Well, we are right in there, although if we take a look at where we are at this point of me making this video, we're at the end of January, and no surprise, the market has pulled back a little bit in January. Typically, you get a little bit more rough spots through February, and the market begins to pop after February into March. So I might expect, based on what we just saw on the transportations not doing as well as the industrials and the seasonal factors, that we may get some more chop before the market moves. That's something to keep in mind, but remember, trend is up. We're not going to be aggressively selling. So observations, seasonal period is neutral to bearish from February to March. After March, they're seasonally bullish. Conclusion, from a seasonal perspective, we should look for a potential pullback, especially based on the industrials versus transports that we were just looking at in maybe February. And then if that happens, it's probably not going to be a massive correction, and we should use that as an opportunity to get into the market if prices fall. Step 4, using market macro sentiment indicators to give us another clue as to what the market may be doing down the road. I covered this in my 3rd video, Technical Analysis Basics, using market behavior. Let's take a look at the VIX, which is one of the indicators I discussed in that 3rd video. And what we can see here is that the market recently moved off of what I would call the danger zone, which is when people are too complacent, investors are not fearful, and it's moved up a bit. We're moving into a period of more volatility. That tends to be a sign that there may be danger to come, but at this point, it's not at any extreme. Investors are not too complacent, but they're not too bullish either. It's just moving in a general direction of higher volatility, and that can mean maybe more rocking and rolling as we head into the spring, which is typically a time, as I mentioned in the seasonal part of this video, where markets can be a little soft between January, February, and early March. So this might be expected that we start to see more volatility on the VIX. We don't panic unless we're in an extreme at either end, and we're really right in the middle as far as seasonality and as far as sentiment goes. We'll just cover one other sentiment indicator. I wanted to cover the CNN Fear and Greed Index. Now, you guys may know that I wrote a book on sentiment. In fact, I'm a CMT, Chartered Market Technician, and I had to write a thesis on something in technical analysis. I chose to write a thesis on sentiment, and in fact, I wrote the book on it. It's called Smart Money, Dumb Money, and it's available on Amazon and all your usual bookstores. If you like the idea of behavioral finance, my book is kind of a go-to. So CNN is got a tool called the Fear and Greed Index. It's readily available to all investors. You don't have to pay for it, and it really gives you a picture of where market investors are as far as their attitude towards investing. Are they fearful? Are they extremely fearful? Or are they extremely greedy, or anywhere in between? Right now, the market's relatively neutral. It's in the fear zone. And I took this, as I said, near the end of January of 25, which may indicate that, again, the volatility index we were just looking at is going to continue to climb a little bit, but it's not outright greedy or extremely fearful either. It's just kind of near the middle. It doesn't really give us any edge when we look at this indicator, but I did think that I'd like to show you the indicator as of the end of January. It does tell us that we might expect a little bit more chop because of the increased level of fear on the markets, which, by the way, just 2 or 3 months ago was extremely optimistic in the greed area. The next step is to look at market momentum. Now, if you go back to video number 3 in this Technical Analysis Basics series, you'll see the momentum section that I am going to cover right now. For more details, see that video. So let's zoom in on the S&P 500 with 3 momentum indicators that I like. The bottom one I'm going to start with is RSI. Again, see that video number 3 to get a full explanation of how it works. But what we're seeing here is, even though the stock market is making higher highs and higher lows, momentum is drifting down. What this is telling us is that the velocity of price movement is slowing down significantly. That often leads into a sharp correction. So it doesn't mean we sell today, but it's telling us ahead of time that unless things change for price momentum, eventually the market will fall, or at least has a good chance of falling. Never say anything absolutely in the stock market, by the way, so I will correct myself on that. You don't know the market will fall, but clues are that there's a good likelihood of that happening. Now we're looking at MACD. That's another interesting indicator, because what we're seeing here is when the market was climbing here, MACD went up, which is what it's supposed to do. But the market has since then continued climbing, and notice once again, the price momentum is going flat. That's divergence again. MACD is a pretty long-term indicator, as you'll remember from my third video. So it's an indicator that's telling us well ahead of time potential changes in market movement. So finally, one of my favorite indicators is money flow momentum. Now this combines volume, and whether it's positive or negative, and compares it to price momentum. And you can see that money flow index is moving down again against an up market. So these are 3 clues that we're looking at right now that the market is losing velocity. Its price is going up, but the velocity of that price is starting to slow down. And that's important. Remember my analogy in the third video when I talked about a baseball. You throw the baseball, it's still moving forward through the air, but it's beginning to slow down and eventually hits the ground. So we need to see momentum pick up, or this market will correct. Observations from the stuff we just looked at. First of all, we have an indication of growing fear, but overall the VIX is neutral. The CNN Fear and Greed Index is growing fear, but there's no panic buying opportunity here either. So again, it just means growing volatility. Momentum, by the 3 indicators we were just looking at, are all diverging negatively. This suggests a correction may be pending. It's not an immediate thing. I want to keep emphasizing that, because markets don't move on a dime. What we look at momentum indicators and sentiment indicators for is to get a heads up on potential movements, but ultimately we pay attention to the trend. Higher highs, higher lows above the 200-day moving average. Macro decision time right now. What am I thinking as a portfolio manager late January 25? Well, the seasonal period of market strength tends to pause in January and February, and then it picks up again in March. On the positive, that's a good positive that we probably have some more upside before the spring. However, there's maybe a short-term period where we could move in on a short pullback. The trend is bullish, and that really should have been the first thing I mentioned on this list. We'll just cover the other positives before we get into the negatives. Sentiment is fearful, but it's absolutely not panicking or overdone on a overly positive either. And February can be a great month to buy. And the time of me speaking here, we're just coming into February. On the negative, breadth is concerning and momentum is concerning. So those are a couple of things that have got me a little worried about the markets right now, which may lead into a bigger correction than the usual blip that we see in late January, early February. So my decisions are that we have some cash at value trend in our portfolio, although not a lot. We're holding about 12 or 13% cash in our equity platform right now. We're going to use that for near-term buying opportunities, which may occur in February. In fact, as I'm speaking, we've seen a little bit of pullback this month and last month, so I'm looking for more potential opportunities. We're keeping an eye on breakdowns in the bigger trend, given the signals I'm getting, particularly from momentum. So overall, I have to stay in the market. There may be an opportunity to pick up some cheap stocks in the month or so that from the point of this particular video, but I'm also cautious that something bigger may be coming, but you don't predict, you don't assume, you simply prepare for a possibility. I hope you enjoyed this video. We covered all the basics I covered in my videos 1 to 5. And we talked about the trend, we talked about seasonality, we talked about momentum, we talked about breadth, and we then put it together into a conclusion that I was able to make as a portfolio manager at the end of January of 2025. Now, one final thing I want to cover before we wrap this up is that you don't have to be glued to your decisions or observations. In other words, I am going to be changing my mind more than I change my socks if I have to. If things change, if the trend changes, or if the trend keeps moving up, I can deploy that cash or I could raise more cash. This is just a moment in time. And the thing about market analysis is that the market doesn't always do what you hope it will do. So you don't predict, you simply look at what it's doing and you act accordingly at the moment. Right now, I see a trend that's up, so the majority of my money has to be in the market, but there's some implications of a potential correction as seen through the momentum indicators that's keeping me to hold a little bit of powder dry just in case it's bigger than I expect. So I hope that helps. Thanks for watching, and we'll see you in other videos coming up.